25 Strategies of Investing, inspired by Warren Buffett. Welcome. Today, you're about to listen to a collection of timeless investing wisdom. 25 Strategies of Investing inspired by the mindset, discipline, and philosophy of one of the world's most successful investors, Warren Buffett. This audiobook is not about quick money. It is about thinking clearly, acting patiently, and building wealth over time. Take a deep breath, relax, and let's begin.
Strategy 1. Invest in what you understand. This strategy means you should only put your money into businesses you can clearly explain in simple words. If you don't understand how a company earns money, who its customers are, or why people choose its products, investing in it becomes risky. Warren Buffett believes investing is more about discipline than intelligence, because even very smart people make poor decisions when they invest in things they don't understand. When you know a business well, you feel more confident during market ups and downs, and you are less likely to panic or make emotional decisions. Understanding brings clarity, and clarity leads to better, calmer investing choices. Strategy 2. Think like a business owner. This strategy teaches you to see stocks as ownership in a real company, not just something to buy and sell for quick profit. When you invest, imagine that you own part of the business, its products, employees, customers, and future growth. Warren Buffett suggests asking a simple question. Would I be comfortable owning this company even if I couldn't sell the stock for 10 years? If the business is strong, trustworthy, and well-managed, short-term market changes won't worry you. Thinking like a business owner helps you focus on long-term value instead of short-term price movements. Strategy 3. Focus on the long term. This strategy means investing with patience and a long-term mindset instead of trying to make quick profits. The stock market rewards people who stay invested in good companies for many years. Warren Buffett became successful by holding strong businesses for decades, allowing time to work in his favor. When you invest for the long term, short-term market ups and downs matter less, and the growth of the business becomes more important. Strategy 4. The power of compounding. Compounding happens when your investment earns returns, and those returns start earning more returns over time. In the beginning, growth may feel slow, but as time passes, it accelerates and becomes very powerful. The key is to start investing as early as possible and stay consistent without interrupting the process. Time allows small amounts to grow into large wealth. Strategy 5. Avoid emotional decisions. Emotions like fear and greed often cause investors to make poor choices. When markets fall, people panic and sell, and when markets rise, they rush to buy at high prices. Warren Buffett teaches that successful investing requires staying calm and thinking logically, even when others are reacting emotionally. Controlling emotions helps you make smarter and more stable decisions. Strategy 6. Buy when others are fearful. This strategy encourages investing during times of fear and uncertainty, when prices are often lower. Many people sell during market downturns, even when the business itself remains strong. These moments can create great opportunities for long-term investors. It takes courage and confidence in your research to buy when others are afraid. Strategy 7. Margin of safety. A margin of safety means buying a strong business at a price lower than its true value. This gives you protection if something unexpected goes wrong. Instead of paying a high price, you leave room for mistakes or market fluctuations. This strategy helps reduce risk and increases the chance of long-term success. Strategy 8. Quality over quantity. This strategy focuses on owning a small number of high-quality businesses rather than many average ones. Warren Buffett believes it's better to invest deeply in companies you truly understand and trust.
Owning fewer, better investments allows you to monitor them carefully and invest with confidence. Quality businesses tend to perform better over time. Strategy 9. Strong management matters. Good leadership plays a major role in a company's success. Honest, skilled managers who think long-term can guide a business through both good and bad times. Look for leaders who care about shareholders and use company profits wisely. Strong management helps build lasting value. Strategy 10. Consistent earnings are key. Companies that earn steady profits year after year are usually more reliable and easier to evaluate. Consistent earnings show that a business model works and can handle challenges. Warren Buffett prefers stability over excitement because predictable performance reduces risk. Steady growth often leads to long-term success. Strategy 11. Avoid debt-heavy businesses. This strategy warns investors to be careful with companies that rely too much on borrowed money. High debt increases risk, especially during economic downturns when income may drop but debt payments remain. Even a strong business can struggle or fail if debt becomes unmanageable. Companies with low debt have more flexibility and can survive difficult times more easily. Strategy 12. Economic moats. An economic moat is what protects a company from competitors. This advantage could come from a strong brand, loyal customers, unique products, patents, or lower operating costs. The stronger the moat, the harder it is for other companies to steal market share. Businesses with wide economic moats tend to remain profitable for a long time. Strategy 13. Ignore market noise. Market news, opinions, and predictions change constantly and often create confusion. Successful investors don't react to every headline or short-term movement. Instead, they focus on how well the business is actually performing. Ignoring market noise helps you stay calm and make better long-term decisions. Strategy 14. Price is what you pay, value is what you get. This strategy explains that a low-priced stock is not always a good investment. True value comes from how much profit a business can generate over time. Sometimes a higher-priced stock is actually a better deal if the business is strong. Always judge a company by its value, not just its price. Strategy 15. Be patient with great businesses. Once you invest in a strong, well-run company, patience is essential. Selling too early can limit your returns just as much as making a bad investment. Great businesses need time to grow and reward investors. Patience allows long-term growth and compounding to work fully. Strategy 16. Learn from mistakes. Mistakes are a natural part of investing, even for experts like Warren Buffett. What matters most is learning from those mistakes and improving future decisions. Each mistake teaches valuable lessons that increase experience and wisdom. Treat mistakes as learning opportunities, not failures. Strategy 17. Simplicity wins. This strategy reminds investors that investing does not need to be complicated. You don't need complex formulas or advanced theories to succeed. Clear thinking, common sense, and understanding basic business principles often lead to better results. When investing feels simple and logical, decisions become easier and more confident. Strategy 18. Reinvest profits wisely. Strong companies use their profits to grow the business further. This may include expanding operations, improving products, or increasing efficiency. When profits are reinvested wisely, the company becomes more valuable over time. Smart reinvestment supports long-term growth and stability. Strategy 19. Protect your reputation. Reputation is one of the most valuable assets a company can have. It takes many years to build trust,
but only moments to lose it. Investing in companies that act ethically and honestly reduces risk. Trustworthy businesses tend to last longer and perform better. Strategy 20. Avoid speculation. Speculation focuses on guessing price movements rather than real value. It is closer to gambling than investing. True investing means owning businesses that create real products and profits. Understanding this difference helps you avoid unnecessary risk.
Strategy 21. Stay within your circle of competence. You don't need to understand every industry or opportunity. Focus on businesses you know well and can confidently evaluate. Respecting your limits helps reduce mistakes. Investing within your knowledge zone leads to stronger, more confident decisions. Strategy 22. Cash is a tool. Cash gives you freedom and flexibility. It allows you to take advantage of great opportunities when others cannot. Instead of rushing to invest, waiting with cash can be a smart strategy. Patience combined with available cash creates power. Strategy 23. Ignore short-term performance. Short-term market results can be misleading and emotional. A company's value is better judged over years, not days or months. Long-term progress matters more than temporary gains or losses. Staying focused on the big picture leads to better outcomes. Strategy 24. Discipline beats intelligence. Being highly intelligent does not guarantee investing success. Self-control, patience, and consistency are more important. Discipline helps you stick to your strategy even during difficult times. It keeps emotions from controlling your decisions. Strategy 25. Keep learning forever. The best investors never stop learning. They read, think, and continuously improve their understanding. Knowledge grows stronger over time, just like money through compounding. Lifelong learning leads to better decisions and long-term success.
Investing is not about being perfect. It is about being patient, thoughtful, and consistent. By following these 25 strategies inspired by Warren Buffett's philosophy, you build not only wealth, but wisdom. Thank you for listening.